For this session, we now talk about your share-based payments, which is covered under PFRS 2. So we are to learn how to compute for the amount of your share-based payments as to whether it should be presented as an asset or what amount should be presented as an asset, the amount will be presented as a liability or part of your equity. So share-based payment. A share-based payment is a transaction in which the entity receives goods or services either as a consideration for its equity instruments. So this is the first one. You receive goods or services in exchange of your equity instrument. We call this one as equity settled. Or by incurring liabilities for amounts based on the price of entity shares or other equity instruments of the entity. So you have received goods or services, but it is based on a liability, and that liability is indexed to the price of entity's shares. So the amount of your liability is based on the entity's shares, so still based on a share. So you receive the goods or services indexed on a price of of the shares of the entity. We call this one as cash settled. So in this particular topic, what we need to learn is how do we account for an equity settled or a cash settled share-based payment. So again, in a share-based payment, you receive goods or services and you exchange your equity instrument, or you incur a liability that is based on the price of your entity shares so that you have a share-based payment. So dalawa lang ang share-based payment natin based on the definition under PFRS 2. So what is the scope of your share-based payment? The concept of share-based payments is broader than employee share options. So normally what they think about your PFRS2 is only a share option or employee share option. And that is already discussed in the other topics as to your share options. But your PFRS2 encompasses all issuance of shares, rights on shares, or any return for in return for goods or services. So long as there is an exchange of your goods or services, and you have either shares as payment or you have a liability based on the value of those shares, we call this one as share-based payments. So what are your different share-based payments? We have your share appreciation rights, your share purchase plans, your employee share ownership plans, and your share option plans. Actually, these three items are likened with each other, but for the context of PFRS2, your share appreciation rights are your cash settled transactions, and your share option plans are your equity settled transaction. They are considered your equity settled transactions. So cash settled, share appreciation rights, equity settled, share option plans. So our main issue now is when do we classify it as cash settled and when do we classify it as equity settled? So here are the different classifications of your share-based payments under PFRS2. If you will issue your own share or share options, it is known as equity settled. So these are your share options plan. And if you will issue cash or other assets, it is known as cash settled. So this is based on your stock appreciation rights. So you have a liability out of the value of your stocks. And if ever, it can also be a hybrid of cash or equity settled. So that can either be an equity or cash settled. If it is a hybrid of equity or cash settled, you need to classify whether it is equity or it is cash. Therefore, it boils down to these two items, whether it is equity or cash settled. Now, since we already know how to recognize and properly classify a share-based payment, if ever we only have stock options equity settled, if share appreciation rights cash settled, our next problem is how do we measure this equity settled and cash settled? So First, before going to your measurement, let's look into your recognition. So the recognition of your cash and equity settled depends on a vesting condition. So what is a vesting condition? A vesting condition is any condition that the particular owner of the appreciation rights or stock options must meet before he can qualify on getting the stock options or stocks or getting the share appreciations. So generally, your vesting conditions can either be considered as a market condition or a performance condition. Market condition or a performance condition. Further, it can also be classified based on whether the what do we call this one? The employee will remain into the employee after a certain period. Okay? So whatever is the condition, so long as there is a condition attached, we call those vesting conditions. And we must meet first all the conditions, meet the conditions so to qualify, so that you can qualify. Therefore, if you do not meet the condition, you cannot qualify for a share-based payment. Now, if there is a vesting condition, you should recognize it over the vesting period. In short, you should defer it over the vesting period. When we say you defer it over the vesting period, what we do is we try to divide it over the term of the vesting condition. Next, if without vesting condition or no evidence of vesting condition, we recognize them in full. So in short, it is like a pure share-based payment. It does not have any condition at all. Since there is no condition at all, you recognize in full the amount of share-based payment. If there is a condition, you recognize it over the vesting period. So for example, the condition is that you must remain in the as an employee for the next 3 years. So your vesting period is 3 years. You need to uh, divide the amount of our share-based payment over those 3 years. So we have 1/3, 2/3, and 3/3 to get for the value over the vesting period. But if it's without vesting condition, you will recognize outright the amount of your share-based payment. But if it's with vesting condition, you defer the recognition of that particular uh, share-based payment. How do we measure it? If it's equity settled, if it's transaction with non-employee, fair value of goods or services received, fair value of equity instruments. If it's transactions with employee, fair value of equity instruments only. So take note, if it's with non-employee, you have two: goods or services, equity instruments. With employee, fair value of equity instruments. At what amount? Or what particular date? At grant date. So get the fair value at grant date. Do not remeasure it. No remeasurement. While in your cash settled, whether it is transaction with non-employee or transaction with employee, we measure it at the fair value of the liability at grant date initially and subsequently every reporting period at fair value. So here, there is remeasurement fair value at grant date and every reporting period. So there is a remeasurement here. Here, the amount of the fair value is fixed throughout the period. Here, you need to remeasure every time you need to account for the amount of your liability. That is every reporting period. It is important for us to know the measurement so that you will not be confused as to the amounts presented as an expense or an item of equity. So let's take a look again on your equity and cash settled. So we say it is an equity settled if that is a stock option. And you need to recognize it depending if there is a vesting condition or no vesting condition. But you measure it at fair value based on the fair value at grant date. While if that is the cash settled, we say that it's a share appreciation rights. You recognize it either there is a vesting condition or no vesting condition. And how do you measure it? Every grant date and every reporting period. Every grant date and every reporting period at, again, your fair value. So once you master these items, it would be easier for you to understand